better than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money in the privacy. I make it rain dollars, they watch me disappear.
Hey guys and girls, welcome to this week's episode of No BS with Birchy podcast. I'm your host, Nathan Birch. This is a show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. And that reality is going to come in the form of charts today. For those of you that are watching on YouTube, I've got a video attachment to this. I might get my team to put a slide deck up so you can see through the slides that I'm talking about here. If you're listening via the podcast, well then I'll just go through it anyway. Nothing too exciting on these chart deck, but I always talk about stats, and they can be manipulated for good, bad, or indifferent, and stats are not always right. And I've been asked from people just to go through and look at what's happening in the market, give a bit of a market update, what I'm seeing out there, as well as the data that's coming through. So most people will sit here with a nice little soup and they'd be like, ooh, the data here says that house prices across the median are down 3.3% and all these sorts of things, right? But we're going to have a deep dive. I'm going to pull apart that data and tell you what I'm seeing, what's here, and go through it together. So first slide here, as we go through the core logic data here, it says residential real estate underpins the Australian 12. Residential real estate is $9.3 trillion worth of value. That's just an approximate figure. Obviously, it can't be an exact figure. It's just worth statistical data that they come up with. So you can pull that data however you wish, but it's at $9.3 trillion. If we go and look at other markets that are out there, the Australian superannuation market is $3.3 trillion. Interesting number. However, if we go back like probably 2 or 3 years ago, I remember the stock market being $3.3 trillion back then as well, right? So it's kind of funny when you look at the super fund market, the Australian super fund market at $3.3 trillion. It hasn't done anything in that period of the last 5 years. This is one thing that came out of the top of my head as I'm looking through this data. The Australian listed stocks, the ASX market, is at $2.8 trillion. And if you want to talk about a Ponzi scheme, I think we've identified one right here. The stock market, we're starting to see these companies starting to implode, and mass layoffs, and the recession that's out there, which never gets talked about in this data. And then you go down and it says commercial real estate, $1.3 trillion. So if you think about it, the residential real estate market in Australia, $9.3 trillion, the super fund at $3 trillion, Australian listed stocks, $2.8 trillion, commercial real estate, $1.3. The residential real estate sector is bigger than all other markets they identify here, combined and rolled into one, which is quite ironic. So when we look at that, if something goes wrong with the residential real estate market, values drop by 20%, the banks get into trouble. That would mean the stock market would fall. We've had deflation everywhere. Looking at other areas, like let's say for instance people can't get equity out of their homes because it's too hard to service the debt, so there's no new debt being created, meaning no new jobs being created, puts the country in recession. The other thing is that if people aren't pulling out equity, they can't go down to the shops and get their wife an upgrade, or they can't go and buy a new car, they can't buy new furniture because they're in a recession. So when we look at the residential real estate, people say, well, are we in a bubble? Are we not in a bubble? Looking at the bubbles that are out there, the whole financial system is a big fat bubble. They can't stop inflating this market. And recently, I don't have the data here, but I saw an article, it was only yesterday, someone said it to me, it's off Channel 7 News, saying that the mortgages, instead of being 30-year mortgages, they're extending into 40 and 50-year mortgages. And I've also seen articles out there talking about 99-year leases. So instead of buying the land and owning it, you're getting a company to buy the land, which is like a big developer, and they lease you the land as a land lease for like 50 years or whatever until you die. So you never really own your property. So there's different ways that they're going to manipulate this system. Those that own the land will win, those that own the properties will win. And yeah, if we go through some other numbers here, which is very crucial, the number of dwellings that are in Australia is 10.9 million. I think that's an interesting thing to look at. So we've got here nearly 11 million dwellings, and that means that we've got about 25 million people, 26 million people, whatever it is now, shows a bit of difference. There has been gross sales of property of $465 billion. So if we break it down, that's an interesting number in itself. That's 5% of the property market has been traded over, if that's the case. If the property market's worth $9.3 trillion. That means 5% of the property market got transacted in the last 12 months, which is a big amount of money, a big amount of the property market. And I wouldn't really think, like, you wouldn't really think that that would be the amount that would have transacted. It could be, but just odd number. Could be that, could not be that. If we look at the other data that they have here, which is the outstanding mortgage debt, this one's really important. $2.1 trillion worth of mortgage debt that there is in the country. So the debt on the residential real estate, it's actually much less than what I thought it would have been. The amount of debt, and here's something to put in perspective, the government has taken out $1 trillion worth of debt, right? These stats aren't here, but you can go do the research. They've taken out $1 trillion worth of debt in the last 2 or 3 years, right? The government has taken out the same amount, about half the amount of debt that every single house in the country has on mortgage, right? If you really look at it, this residential real estate market is $2.1 trillion worth of debt. So if interest rates go to 10%, which they can't, but if they did go to 10%, imagine all the other areas where the money is, whether it be the debt is attached to the government, their debt would go up, the corporation debt would go up. We're starting to see these companies fall apart. We're starting to see inversions of yield curves, which is the bonds that are out there, which is very, very interesting. So if I look at this data, I'm actually intrigued by a couple of the numbers. Just looking at compared to size of different things out there. The Australian mortgage market. So if you put together every single bank, Westpac, CBA, Combank, all those banks, all their debt books, there is $2.1 trillion worth of debt. All the wealth that you see within the banking sector is $2.1 trillion worth of debt. However, the government's got $1 trillion worth of debt, right? And that came from nowhere, right? That came from nowhere. So when you think that you've got an issue with your personal budget, think about the state of the rest of the economy. Moving on to second slide here, which is the Australian dwelling value. So I'll give you my input on this, on what I'm seeing, and give you the input here from CoreLogic. So it says here in the last 3 months, this is very interesting as well, just look at the numbers. We saw $3.3 trillion worth of Australian super. In the last 3 months, we've seen a decline in 3.3%, right? It's interesting. I say these threes because they have symbolism out there, but anyway. It says here the national home values fell by 3.3% in the 3 months to December, a smaller decline than the 3 months to November. 12 months, we've seen a 5.3% decline in properties across Australia, which is the largest calendar year decline in home values since 2008. Capital cities, the monthly pace of decline increased through December. December saw the national home values decline by 1.1%, which was steeper than the 1% fall in November, but still below the peak monthly decline of 1.6% recorded in August. Now, I look at that as a few different things. Firstly, if we're seeing less amount of activity happening on the market, that means that there's less transactions happening. That means that there's less stamp duty being claimed for the state, meaning that the state taxes are getting less revenue through. So if there's a slowdown in this $9.3 trillion residential property market, and there's not much activity happening on, that means that there'll be less capital gains taxes being paid. That means that there'll be less tax coming through the ATO. That means that there'll be less tax going to the state government. If there's less taxes going through there, that means that they'll have to go and borrow the money to meet their budgets, which means that they have to take on more debt. So if the property market slows down, someone else is going to absorb, because it's just simple mathematics. The system, you keep expanding it, it needs to come from somewhere. So when I look at these numbers of the largest declines, 3% and 5% negative growth, I don't know what areas people are looking at, right? Yes, there's some markets which have been shot up completely, artificial, silly highs. But as we go through different markets here, I want to go and have a look at what they have to say about what's happening in capital cities and what I'm personally seeing in capital cities out there. So this is what I'm seeing in the market. So there's here some charts which are Australia's negative 3.3%, combined regional areas is negative 3.2%, combined capitals 3.3. These numbers don't really add up, they're all statistical data. This one here is capital cities. Let's have a look at this one. This one here says that Sydney, for the The 3 months to December saw a negative growth of 4.2%. Melbourne saw negative 3.2%. Brisbane saw negative 6.6%, backed up off a negative 5.2%. We've got here Perth has had neutral, is irrelevant. And basically every state is in decline. Well, I would call that out as bullshit, right? Because it depends what areas you're looking at. So if we look at, when they pull their stats, right, I know how they group their stats together. So let's say, for instance, there was 200 sales, let's just say we've got 100 properties to sell this month, right? Because interest rates have gone up, 3% over the last 9 months, right? That's funny in itself. It's gone up by 3%. When we look at people servicing, people can't service the amount of debt that they could beforehand. So the markets that are at the $1.5 million market isn't as hot as what it used to be. But there's a lot more activity in the 300 grand, the 400 grand, the 500 grand market. There's a lot of buyers in that activity. So if there was 100 sales happening 2 years ago or a year ago, based on $1.5 million transactions, there's a lot more activity happening in that price range. But if people can't afford, does it mean that the house prices have fallen? Or does it mean that the 100 properties that are sold this quarter have been cheaper priced properties because they're the ones that are selling? Right? You see where I'm coming from? So when I look at the markets, like if we take Sydney, for example, I'm looking at stuff in like places like Mount Druitt or Penrith, right? Units that I used to pick up for 260, 280 grand going back a couple of years ago, they're now selling for 350, 360, 370. There's an abundance of people out there buying these cheaper stock properties. And I'm not so keen when that happens, right? If we look at Brisbane here, negative 6.6%, negative 5.2%, right? Where are these numbers coming from, right? Because if you're in the Queensland market, whether in the Gold Coast or Brisbane or wherever, you're seeing it's still very hard to get properties. When properties come up for sale, they sell for over the asking price. There's many buyers that turn up to open homes. You've still got a room full of people in open homes. When we look at Brisbane, I'm getting gazumped. It's a hard market to be buying in at the moment, and I don't see those stats are reflective of the price ranges that I'm personally buying into. If we look at Perth, it says here, the market's neutral, it hasn't fallen, it's 0% or negative 0.01%. That's a neutral sort of position. I'm seeing properties in corridors that have been picking up in Perth, stuff that I could pick up in August last year for $150,000 for a 2-bedroom unit. You can't buy for under $190,000 now. These things are renting for $350, $400 a week, but you can't buy them under 200 grand now. So in my numbers, I'm seeing there a 25% increase, right? And I think it's due to the fact that there's less liquidity in those bigger ticket items, and people are being forced more to that. But you don't see it. Like, you can just see headlines, you watch the news, and it says house prices falling by 5%, house prices falling by 3%. But how real is that, and what are they comparing it to? And I used RP data, or CoreLogic, they call it CoreLogic now, which is the same stuff. I used that data going back in 2007, 2008, 2009, 10, 11 and 12. And there was a property, so if you think of the Central Coast, if you're familiar with New South Wales, there's a Central Coast suburb called the Entrance, which is sort of a prominent area in the Central Coast. And there's a suburb called the Entrance North, right? The Entrance North is about a 1 kilometre radius of a suburb, right? And it shares the same postcode as many other locations there. And in it, there was only about, 50 units in the whole suburb beforehand. And in 2008, a developer came in and built 120 units in that suburb. So when you look at the data at that point, all the units were like old and they were selling for like 200 grand. But when these new units got built, they were selling for 400, 500, 600 grand for these brand new units. And for the years after that, for the 3 years or so throughout the GFC, the market showed all the statistical data that the units had gone up by 100% in that suburb over that period of time. And then the GFC came, and in about 2010 or 11, I think it was about 2010, the developer went bankrupt, and I picked up about 30 of the units off the repossession company or whatever. and I got them very cheap. They're like 130 grand, 180 grand, 200 grand per unit. When the data came through for that, it showed that the unit price had doubled in 2 years, and then it had declined by 50% in 2 years. And if you looked at that, you'd think, wow, this is like a very volatile, is that a mining town? But it's just the suburb, it's just the statistics, and it's just a pool of data that they're collecting the information from. So you need to look at that deeper and have an understanding of what is actually really happening in that market. So I love statistics, bring them out every day of the week, but I like real statistics and I like actual evidence behind it, because you get some dickhead with a suit and tie reading this out going, oh, you know, this is how the GDP has occurred in the area, this is that, the next thing. And they're talking of stuff that they have no market knowledge about. So when I pull this stuff out, I like to look at that. So if we have a look here, it says housing cycles. In December, Sydney dwelling values declined. And notice they call it dwelling values. It's not a house price, it's a dwelling price. So are more people buying units now than what they were beforehand, and they're buying houses beforehand. Over the quarter, dwelling values decreased by 4%. Over the past year, dwelling values decreased by 12.1%. I have not seen like the prices of the properties drop by 12%. I'm seeing less stock and less turnover in certain markets which are unaffordable because people don't service there anymore. I haven't seen those prices. If you can find me examples of where the prices have dropped dramatically like that, I'd be very excited to see it. And I'd love nothing more than seeing a 12% reduction in Sydney in price of days. So I'll tell you what happened in 2008, right? A lot of people forget back in the old days. And this year is 2023, and it's been 20 years since I've been investing into property, right? And I remember statistical data from back when I bought and before I bought, and I'm very finger on the pulse there. I remember back in 2007, the amount of defaults, the amount of mortgage stress that there was at that period of time. I believe, looking at the market now, like interest rates used to be like 8%. So at the RBA in 2007, it was 725 basis points, which is still double where it is today after they've increased the interest rates 9 or 10 times in a year. Right? They've gone up 10 times now in 1 year. Right? And people quite often say, Nathan, you said that they won't go up. I said they can't go up. They can't go out without the system imploding. And we're going to see that in 2023. And I'm very confident of it. I'm excited. I'm actually really excited that they've done it, because it means that there'll be lots of stimulus put in the market. It will create even more inflation. But if we look back in 2007, just before the GFC, interest rates hit 725 basis points, so about 8.5%, 9% at the bank. People were going bankrupt. A property with a 200 grand purchase or 300 grand purchase in Sydney was getting $200 a week, and interest rates at nearly 10% was killing people. If we look at a property now with a 200 grand or 300 grand price tag attached, let's say 200 grand price tag, I like 200 grand properties, rent on it for $300 a week, but your interest rate at 5%, let's just say it's 5% in your bank what you're paying. 5% interest rate, 200 grand purchase, your loan at 160 grand, that means 160 grand loan, 5% interest is 8 grand a year. 8 grand a year, 52 weeks, about $160 a week. So if you've got a mortgage of $160 a week, it's gone up from maybe 120, $100 a week, whatever it's gone up from. It's gone up a bit, but you've still got a sufficient amount of rent. I'm not seeing mortgage stress to the point of what was around 2 decades ago. So I'm sure that there's lots of people that have got $1 million mortgage or $1.5 million mortgage, which are now paying an extra 20 grand a year, and they're the people that are going to save me and you and all the other investors that are buying at our price points, because they can't just go, okay, you've got $1 million mortgage, we're going to drop your interest rates down to 1%, and the people on the 200 grand mortgage or 150 grand mortgage, they're going to be kept at 5%. The whole market is going to turn to shit, and they're going to have to put more stimulus in, which will boost up that sort of that sort of in the market. So if we look here, it says here Brisbane price cycles. So it says here, this just doesn't make sense, right? It doesn't make sense. So if we look here, December, the Brisbane dwelling values declined 1.5%. Dwellings over the quarter decreased by 5.4% in Brisbane. But over the past year, the dwelling values decreased by 1.1%. Right? So yeah, they must have gone up at the start of 2023 to 2022, and they've come down very sharply in the later part of 2022. So that's what they say, but what are we seeing out there? Where in Brisbane have you seen a decrease in the last quarter by 5.5%? Perth, it says here, Perth dwelling values for the quarter was zero, literally 0%, not up, not down. But what I'm seeing is a lot of the cheaper stock. Going back 12 months ago, I could pick up a house in Perth for 220 grand, a house in Perth for 240 grand, rent for 350, 380 a week. Now those houses in Perth now you can't find for under $300,000 because the prices have gone up. And if you were to put, 300 grand versus 230 grand, you're probably looking at about a 25% increase in value over the period of the last 12 months, but that ain't reflected in here. So we can look at this for what it is, or we can look at it for what it is, which is just statistical data and a whole bunch of numbers. So have a look here. Sales volumes continue to trend lower as buyer demand slows. Let me say, if you had the ability, I know I've got thousands, tens of thousands of viewers out there that are all investors. You're looking to buy a property, you're looking to invest in a property. Are you, if you could buy the property, if you had access to lending, would you be out buying more property today? That's the question I ask everyone. And I know sure as shit that there's tens of thousands, maybe hundreds of thousands, maybe millions of people that if they could get a loan, they would go to the bank, get a loan and buy a property. So looking at these stats, it says here, sales volumes continue to trend lower as buyers' demand slows. Well, the buyers are there, they just can't afford to because of servicing, and the banks won't be releasing the money. So something has to give at that point. It says here, CoreLogic estimates that 12 months to December, there were 514,000 sales nationally, down 17% compared to the previous year, while down compared to the last year's volume. Sales estimates are still 6.3 above the decade average annual sales volume. You think, well, why were the sales transactions happening a lot more at that point? And that's because there was access to liquidity. There was all these stimulus packages in place, so all these Ponzi schemes to entice people to get into the property market, which pushed that way above what the 10-year sort of average was. But looking at it down by 17%, that could be right. There's a lot less stock out there in the market. People do not want to be selling their properties. They're sort of from the flip side, right? You sell your property, what are you going to get? Is that money that I think about it now, right? If I'm buying a property for 100 grand or 80 grand or 150 grand, someone is paying like 2 grand to sell their property as a legal fee, right? That's like 2% of the sale price that they're paying as a legal fee. I look at that, they are paying stamp duty of like 3%. I think to myself, like, why would you want to be selling off a property for such a little amount, right? And there's lots of people out there like, nah, I'm not going to my price, I'll just keep it, because they're not forced to sell it because the rents are so high and there's a lot of cash flow coming from these assets. So, there's a lack of stock out there in the market. There's a lack of buyers at certain levels because they can't afford to be buying because the servicing doesn't allow that to occur. Vendor discount, it says here that vendors are giving, what are these? This is the important part, right? This is the really important part to the property market, right? You want to see if the market is crashing or not. In 2000, if we just looked at Australia as a whole, in December 2022, when a property goes on the market, the vendor discounted the price on average by about 4.3%. But in 2021, the vendor was reducing the price by 2.9%, right? So in reality, when a property goes on the market, the difference between negotiation price on it is only an extra 1% of that value. So on a 200 grand property that's 2 grand, you get off different than what it was the year beforehand. And does that mean that that's just the asking price versus the price that the property actually traded in for? So just interesting. We look at listings. In the 4 weeks to 8th of January 2023, the volume of new listings totaled 13,936 nationally. The new listings trend is moving through a seasonal low and is also 22.1% lower than the previous 5-year average. So on the average of the last 5 years, the amount of stock that's on the market is 22.1% less than what it has. That there is so important, right? All these house prices have fallen and shit, don't buy it, right? There's less listings by 20%. That means that there's less people wanting to sell because they have less respect for the money that they're receiving for it. If it was a forced seller's market, if it was a crashing property market, we would see an increase of listings on the market. But now we're seeing a stock deficit of 22% less listings in the market. Very, very important. Yeah. Weekly clearance rates, don't buy into that. The rental market, this one's the exciting one for all the investors. The annual growth in rent values has re-accelerated. Annual growth in Australian rent values was 10.2% in the 12 months to December, a new record high. This has partially been driven to the growth in units, rents across Sydney, Melbourne and Brisbane, where rents have increased at around 14 to 16% annually. I'm seeing, whenever I buy a property from one of my investors through my buyer's agency, we're putting our rents up probably 15 to 30% upon settlement of the property, and they're way behind the 8 ball. So when we look at this statistical data, if rents are increasing by 14 to 16% annually, you just need to take a step back for that, right? And think, what is the central bank doing in this country? Because it's more than the statistical data that you're seeing here from CoreLogic, right? The data that you see from this, right? You're seeing the CPI, the CPI, which is the Consumer Price Index. They say that, oh, well, house prices have gone up by this or that, the next thing. Well, if 50% of the economy is renting a property and their rent has gone up by 14 to 16%, and that's just what's reported, and I know that on the ones that I put up are like 20%, 30%, 40%, whatever, right? That means that the cost of that household's expenses have gone up by 20%. That's a lot higher than the 7% inflation that they're reporting on, isn't it? Why are property rents going up so high, do you ask? Well, firstly, you've got inflation going up, so you've got the cost of building the property going up and all that sort of stuff. Most importantly, the cost to the investor. There's either less investors in the market because they're not wanting to invest for people to have rental properties, or they're passing on the cost because the interest rates have gone up. So this is where the funny part is, right? And this is where the hyperinflation, you're starting to see cracks in the system of where the hyperinflation will start to trend from. And when they start reducing the cost of capital out there, of liquidity, and a reversal in monetary policy, so we've got a tightening, it's called quantitative tightening at the moment, because they're removing money out of the system. We're going to see more money being injected in the system. That's when hyperinflation will start through the cycle. So if we look at the next chart, we can see here dwelling approvals. So the monthly house versus unit approvals nationally. It says here the decade average houses approvals is it's about 10,000, 9,000, 10,000 a month that are being put through. And throughout the course of 2018, so if we look at this chart, this is a really important chart to have a look at here. If we look at the chart here between 2018, 19 and 20, you'll see that the house approvals have fallen off a cliff, very much similar to what they did in the GFC, very much similar to what they did in the Y2K or the dot-com bubble. They crashed in 2017 to 2020, which is when we fell into a real recession. We fell into a recession in 2017, 18, 19, just before 2020. Then we saw the spike, which went way up high. There was so much dwelling approvals going through over the last couple of years, which was all fake, right? It was all from stimulus packages and whatnot. If we have a look at the market now and the amount of approvals that are coming through, it's going way below the decade average for house construction. So that will be interesting to see how that pans out over the next 2 years, 3 years, 4 years. If we don't stimulate and put measures in place, there's going to be a lot of tradies that can't afford their Ford Ranger Raptor or their Ram Ute. They're going to be issues, and that will flow out onto the streets, literally. If we look here at the chart where it shows the dwelling approvals for units, it's an average, a decade average is about 7,000 unit approvals per month. And if we have a look at it from about 2017, when the market crashed beforehand, it fell below that median line. And even with all these stimulus packages and all these things coming into the market, it never got back up. So there's not enough building or new approvals for units being created at the moment, which is a very interesting sign out there. Obviously, it's going to put more pressure on rentals and whatnot. We keep going through these charts, but I think we've seen a lot today, and these go back and rehashing a lot of the stuff that we've talked about. But that is my view on the market. This is a view of CoreLogic. My view of adding my 2 cents in there, but if you want to know my view on the whole market, obviously you can reach out to my team and contact us. But my view is that the market, there's inner markets and there's outer markets, so you can't look at a blanket and say, okay, Australia is one whole economy. There's inner markets and outer markets. You need to know what's happening from location to location, what's driving those markets, and be diligent and think, okay, well, what would happen if this was to occur? What would happen if that was to occur? And sort of prognosticate different outcomes and what trajectories would occur if certain things were to be put in the equation. So, yeah, on that note, guys, if you do need help, you do want a bit more information about what's happening out in the market, reach out to us, 1300 367 925, email us at admin@B.Invested.com.au. And make sure you tune into us every Tuesday at Spotify, Google Play, and Apple Play, and YouTube. We'll catch up soon. Have a great day. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar about to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you've been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I've never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all telling lies, I know what they been telling you. I'm the opposite of Donald Trump of Australia. It's amazing, there for the taking. My time is never wasted, just getting wasted. These girls say I'm really breathtaking. I can't help it if I really